Well, I think there's a number of things that are driving inflation. That's why I don't really subscribe to the transitory camp or the non-transitory camp. I think there's elements of both. The first thing that happened was in the pandemic, there was a big shift in the composition of demand away from goods, away from services to goods, because you couldn't go out, you couldn't travel. So people bought a lot more goods than they typically did. And that put a lot of pressure on supply chains. And that's why we saw a big increase in goods prices. So that's number one. Number two, we had good productivity growth for a while, the early phases of the pandemic, but we've had absolutely horrible productivity growth over the last year. And so that's also been a contributor to inflation. Number three, fiscal policy was very expansive, both during the Trump administration and the Biden administration. So a lot of transfers to households and businesses. So when the economy opened up, people had lots of money to spend, and they spent it. And so the fiscal policy stimulus was an important factor. And then finally, the Fed kept monetary policy too easy for too long, and we sort of know that because when the Fed tightened 75 basis points 4 meetings in a row, that's essentially a mission that they've been very late in terms of removing monetary policy accommodation. So some of this you could chalk up to difficult to forecast how things are going to be coming out of a pandemic. But you could also argue that the stimulus on both the fiscal and monetary policy side was kept in place much too long. Once the vaccines were introduced, it was pretty obvious that the economy was going to go back, to a more normal footing. I think that was the time to start to remove monetary policy accommodation. The Ukraine-Russian war was obviously another shock that just sort of exacerbated the supply chain disruptions. Energy prices went higher. So, but I mean, we already had a lot of inflation before the Ukraine-Russian war. The reason why the Fed introduced a 2% average inflation targeting regime was because, if you remember back in the last cycle, the Fed was having trouble pushing inflation up to 2%. And as a consequence of the Fed's persistent shortfalls of inflation relative to their 2% target, inflation expectations were starting to become a little bit unanchored to the downside. Not dramatic, but a little bit unanchored to the downside. And this caused the Fed to start to worry about the Japanese type situation where you don't have, short-term rates aren't very high. You don't have much room to cut rates in a recession. You get pinned at the zero lower bound for interest rates. Inflation keeps falling. Monetary policy gets tighter, and you just can't get out of that situation. So the Fed basically said, look, we need a regime that doesn't target 2% inflation at any particular point in time, but targets 2% inflation on average. So this is to the downside will be offset by misses to the upside. This is the upside will be offset by misses to the downside. And that way people will know that inflation expectations should stay well anchored at 2% because we're going to offset those misses. I think all that was completely sensible and a reasonable response. The problem was how they operationalized it. The Fed operationalized it by basically saying, we're not going to raise rates until we get to 2% inflation, full employment, and we're confident inflation is going to get to go above 2% for some time in the future. So that means that rates are at zero, even as the economy is beginning to start to overheat. They exacerbated that further by basically saying we can't raise rates until we finish asset purchases, and we can't just end asset purchases. We have to taper asset purchases. And we can't just taper asset purchases. We have to talk about tapering asset purchases before we actually begin to taper. So all these things stretched out the process by which the Fed would actually begin to raise short-term interest rates. And that's really, I think the Fed was probably 6 to 9 months too late. In my mind, once the vaccines were introduced, it was pretty obvious that the economy was going to reopen again. That was probably the time to end the quantitative easing. And then once quantitative easing was over, you had a pretty clear sailing for when you wanted to actually start to lift off. The last war was about inflation was too low. We didn't realize we had that much room in the labor market, so let's let things run. And it turned out that was not really very suited to the current environment. I would say, at least in talking about the United States, which is my experience, I think the political pressures are pretty, very, very modest. I mean, we didn't talk about the political situation at all when we were talking about monetary policy in the 11.5 years I was sitting at the FOMC table. I think that there's a lot of publicity about that pressure, a lot of press about that pressure. But I think the Fed basically view is, end of the day, Congress has set the mandates for the Fed, price stability, maximum sustainable employment. Our job is to try to carry out those two mandates. And that's what they try to do. They don't try to, tack one way or the other just because a particular party's in power. And, the Federal Reserve is set up in a way to insulate the Fed from political pressure because the Board of Governors terms are 14 years long. and the presidents can serve for 10 years or until they get to 65 years old. So you have positions that don't turn over that. I think basically two things happened this year. Number one, they were very far away from where they needed to be, so they were at zero in early March, and at the time the economy was basically already at full employment, and inflation was running above the Fed's 2% objective. And number two, the subsequent information that they received from March told them that the inflation was much more persistent and there was much less slack in the labor market than they thought. So part of the 75 basis point series was to catch up, but part of it was also that the new information is telling us that we also need to do more. I think we have somewhat better information because the Fed is much more focused on financial stability than they were prior to the great financial crisis. I mean, they have a whole group now that just focuses on financial stability. And twice a year, they publish a financial stability report giving their assessment of risk. So I think that's a positive. But I think the bigger positive is all the things that were done post the great financial crisis to make this financial system more robust. When you think about the banking system, more capital, higher quality capital, stress testing, liquidity requirements, a focus on good governance, a focus on good data, people looking at the validity of the models that are used. So, the core banking system is much more secure today than it was, 15 years ago. You certainly worry about whenever you're raising rates this fast that somebody's going to be caught out, and that's going to create some financial instability. I think the interesting thing in this current situation is we haven't seen any of that. I mean,
Right.
the UK had a lot of problems as they had a big uptick in gilt yields, which then contributed to lots of problems in terms of their pension system. But in the United States, we haven't seen very little consequence of the Fed raising rates this quickly. So, it doesn't mean that problems won't arise, but so far so good. I mean, the biggest area of problems that we've seen, in terms of financial stability on a global basis, is not in the traditional finance sector. It's in DeFi and what's happening in the crypto ecosystem. It reminds me a little bit of the Great Financial Crisis in the sense that you think about the Great Financial Crisis, it was based on a belief system that turned out to be false. National home prices can never decline. Subprime lending is safe. AAA rated CDOs are safe. And those all turned out to be wrong. And I think what's happening in the crypto ecosystem is that you have these tokens that were sustained basically by belief. And as long as activity was increasing, that was supporting the value of these tokens. And so it was making everybody comfortable that this thing could just keep going. As soon as you start to see, sort of chinks in the armor and entities start to fail, the whole thing starts to run in reverse. People start to say, well, maybe these tokens aren't really worth what I thought they were. The values decline. That puts stress on the issuing entities. And next thing you know, parts of the crypto ecosystem are starting to fail. So my own view is that nothing that surprising about what we're seeing. It's probably got a considerable ways to go, because every time someone fails, that places loss on other players in the ecosystem, so it weakens other players. And every time someone fails, that reduces trust in the system, and that also then dampens activity, reduces revenue and profits. And so, the downturn tends to keep going. And in some ways, it's more dangerous for itself, in the sense that there's no lender of last resort here. There's no Federal Reserve that's going to come along and introduce special liquidity facilities. The Fed's not going to cut interest rates because of what's happening in the crypto space. The crypto system is, it's big, but it's not big enough to be economically systemic from the Federal Reserve's perspective. And as a consequence, because it's not big enough to be systemically important, no one's going to come along and rescue it. The other thing I'll say that's going to happen is we're going to see more regulation. Just like the Great Financial Crisis led to a lot more regulation for the traditional financial system, I think we're finally going to see movement on regulating a lot of these entities a lot more closely.